Everyone, just waiting for David to put the recording on, and I can see on my GoToWebinar panel that's now happening. So we are good to go. So first of all, welcome to what is for us our second webinar. I see some of you were with us earlier on today when we looked at only the forex market just before the London Open. So welcome once again, and wherever you are in the world, again, it's lovely to have you with us this afternoon. And for August, gosh, it's all sort of kicking off in various directions. So before we start, before we go and look at some charts, can I just draw your attention to the disclaimer that I know you can see on the screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. So those of you who perhaps are coming along for the first time, this is me. Next to me is my husband David and my trading partner in crime sitting over to the right, and together we're going to be looking, as I said, at we call this session day trading. We've got some ideas for it that we're probably going to be looking at when in September sometimes, but essentially what we're going to do is we're going to be looking at the markets, the different instruments that can be, well, you can trade anything on a day trading basis: bonds, commodities, forex, stocks, futures, etc., etc. But we're going to kind of broaden our horizons a little bit on the charts that we're going to be looking at today. I think we've got a bit of forex. Have you got some commodities, David? We've got some commodities, indices as usual. Yeah, indices, and I think I've got Nestle somewhere. I've got to have a look, but if we've got time, we'll have a look at that as well. And the reason we can look at such a broad selection of markets is because the methodology that David and I have used and have kind of developed and worked on, which is volume price analysis. You can apply it to any market and any time frame. So, you know, whatever the ticker is on the top left hand of the chart, the analysis is the same, and we'll look at the charts through the prism of VPA with our quantum trading tools. Now, if VPA, volume price analysis, is something that you've never come across before, you can find all the information you need at Amazon. This is the first book, and it's a complete guide to VPA. I think it was published in 2013, 2014. I think we've got yes, something like that. I thought we've got more than 5 stars. How many have we got now? 280. Oh well, anyway. It's over 300 now. It's used, the methodology is not just for independent traders. Institutional traders apply this methodology. It consists of 5 elements, which is obviously price and volume, support and resistance, not just price-based support and resistance, but also volume-based price and support and resistance. We use candles and candle patterns. There are other traders out there who use volume in their analysis. Sometimes it's called volume spread analysis. Sometimes it's also called volume price analysis. But they don't always use candles and candlesticks and the patterns. They tend to use price bars. Ours are very, very particular using the candles and candle patterns. And you know, when you look at a chart using candles, you will see why. And finally, there's time in the sense of multiple time frames, but also, as I mentioned this morning, time where you are aware of the session that you are trading, particularly if you are in trading a market that runs on a 24-hour basis. It's really 3 markets in one in that 24-hour period. So you have the Asia session, you have Europe, London, and now, of course, we're coming into New York. All the sessions have different depths of liquidity, different levels of participation. It doesn't invalidate volume price analysis and your analysis of what you can see on the chart on the volume histogram, but you do have to be aware that, you know, it's almost like 3 separate markets opening and then closing. And what we've done is, as a companion to the book, a lot of guide, and they wanted more examples taken from the markets across the. Sorry, am I? Oh well, I'll try and It might be the internet. If I do drop out, it's probably just the internet, and it'll has the radio gone? I think I might have dropped. Can you hear me?
I can hear you fine.
Oh, fine. Then I'm still. If David can hear me, then it's fine. Essentially, the book is, as I said, 200 worked examples. This is for the indices, commodities, the stocks in there. There's also one for forex, and we've actually bundled it together here, and it's $7.99. It's a digital version. The tools that I mentioned, they're our own. We've developed them for ourselves, and we use it in conjunction with VPA. It's they're very specific. There are some forex specific ones, and the rest can be used in any market. And I'm just going to straight onto the site. You'll find details of the tools here at quantumtrading.com, and you can see the platforms that they're available for: MetaTrader, Ninja, and TradingView at the moment. But we are also working on TradeStation, and basically you can buy one indicator. There are bundled deals, or there's a complete package. There are lots of advantages for buying the complete package. One of them is that when we develop new tools, they're automatically added to your package for free. Everything is covered by a 7-day money-back guarantee. If you start with one and then you want to upgrade to a bundle or the package, you will always be credited for whatever you have spent with us. Support is 24/7. All upgrades to the indicators and the platform are free as well. This is my site, annacooling.com. Here you find all the books that are currently on Amazon. You'll find the analysis, the stock analysis, indices analysis, details of the various Facebook pages that I run with. Again, they're specialists. There's a forex one, a commodities one, a stock one. So there's everything that you really need to, extend your knowledge, your knowledge of volume price analysis. Anything you want to add to David? No? Fine. Yes, I will. I just want to take that down. Basically, this morning, we're talking about time this morning, and what we were looking at was the Euro Aussie and the combination of time frames that I was using from 6 o'clock this morning, when this was just before the European Open, and it was the Euro Aussie, because obviously today we've had a lot of European news this morning. This was the hourly chart. The move started from here. It started at, let's have a look. This is it was at the tail end of the Asia session, but it was the move away from the volume point of control here. And this is where I said this is price support and resistance based on volume, price, and time. And we talked through the trade. It was actually this bit of the trade that we saw, the sell that we saw in the euro and the Euro Aussie in particular. Then we had the news, which was the PMI data for France and Germany. The euro then actually shot up, and this is a really nice example of, by using an hourly chart. Obviously, I wasn't in, when this move started, I was still fast asleep, but this candle combination was evident. There was a hanging man. There was a sort of shooting star, but not quite a shooting star because it's got a little bit of a body, but it had some weakness. Why? Because it's got a wick to the top of the candle. Support and resistance from a price-based perspective, I've got this resistance line here. The one thing about support and resistance you have to remember is these are calculated on MT4 and 5 with absolute pinpoint precision, but price action will often go through it and then perhaps come back again. So the actual price action itself, you have to be allow a little bit of flexibility. But this was the candle. Now with Forex, those of you who know, we use our currency strength indicator, which basically tells us what the individual currencies are doing at any particular time. If I hover over here, you can see 8 o'clock. This is actually 6 o'clock, which was the time that I came to my screen. The euro had been bought overnight. It kind of went a little bit sideways, and this is that down move that we captured just prior to the London Open, and then the release of the data, which was between 8:15 and 8:30 our time. This is the move higher, and you can see here we've had a swing back lower, and it's just been one of those pairs where you could have taken a trade to the downside, which I did. I came out, I actually went out, I had some shopping to do, and while I was out, there was a trade to the upside, and now we've had the trade to the downside. Now, the other thing about this indicator is what we're looking for all the time is divergence. In other words, we're looking for one line to go in one direction and another in the other, and we've got a nice bit of divergence here on the pound Canadian. This is the Canadian dollar. What happens when the lines are going in the same direction? The indicator is telling us that there is no divergence at this particular time. Essentially, the chart is moving sideways. It's range bound for the time being. The time frames that I used was the hour, the hourly, the 3-minute, the 12-minute chart, and the 3-minute chart. And just very, very quickly, it is actually in the webinar this morning. Let's just reduce that down. Here we are. This candle combination here, this was actually the actual turn itself. When I said it moved over, we have a really nice 2-bar reversal here, which came off, and then it was down to the volume point of control. But the nice thing about Euro Aussie, as I said this morning, a lot of traders in Forex like to stick to Euro dollar because primarily because the spreads that are offered by brokers are very competitive. But Euro dollar has a notorious habit of being very, very range bound, very tight. You know, yesterday I think even with the FOMC, I think we've got 20 pip range, a 60 pip for the whole of the week. I know it's gone has moved a little bit more today, but often you will find some extremely profitable trading opportunities in what we call the cross pairs, of which the Euro Aussie is one of them. So the 3-minute chart is both for entries, but the faster charts are also to be used sometimes for exits. So if you're in a position and nothing seems to be moving on the chart of your choice, and you're not sure what's going to happen, or you have a volatility candle suddenly trigger, go down to the faster time frame, and you can use that to help you exit. Right, I'm going to stop there, David. Can I move over to you, and then we'll move over to NinjaTrader, and then we'll come back here to MT4.
Hi everybody, and a very warm welcome from me. Hopefully you can hear me all right and see my screen. I can definitely see mine over on Anna's, so that's good. So I'm sure you can see it too. I just wanted to flick over onto indices because it's quite interesting at the moment. We've actually got some divergence. Over the last sort of 10 or 15 minutes ago, down at the bottom here, we've got the dailies for the three sisters, the NQ, YM, the NQ, and the ES, and that's on daily. And up on the top, we've got the 5-minute. It's been moving very nicely, moving lower. But what's been interesting about it is that on the YM, the Dow 30, this was actually showing positive for some considerable time. And indeed, on the last sort of 10 or 15 minutes, Anna was talking, it's still showing positive. The reason it's so important is because these two have been trading negative. There we go. No positive at all. Very much down candle on the day. Same on the ES. There we go. Nice down candle on the day. That's building nicely. Decent price moves, very strong. And it just gave you a heads up as to if you were going to trade one of these, you had the choice. You could either trade with these two, which is a pretty solid move, or you could trade the YM on the expectation that what was happening was that sentiment in the NQ and the ES would actually ultimately drag the YM lower, which is precisely what's happened. We've now got rising volume, falling price, which is precisely what we want to see in a falling market. So it's just an absolute no-brainer, low-risk trade, purely by virtue of having these three indices up. It then tells you precisely what's like to happen next, purely because you've got two of them driving the market, and the third one will almost certainly follow. It's not a case of one taking on the other two, it's 2 versus 1, and therefore the weight of that market will drag the other down ultimately. And it was just fascinating to watch. As I say, this was green, not a huge amount of green, but it was definitely up. So we had a complete anomaly across the US markets between the three indices. It happens. When it does happen, it's a no-brainer to make some relatively easy money in that way. So I hope you take that lesson on board. You can see it's falling nicely. Straightforward trading at the moment. This is on the three of them running together. Nothing really to frighten anybody. It's just a straightforward, get in, decide how many points you want to take, put your stop loss in place, and just sit tight. As I say, this is on 5 minute. Just go on to the multiple time workspace where I've got there we go. This is on the NQ I've got set up here. Nice and straightforward. This is on a minute. I'm just going to drop this down to something a bit faster than that. Let's put that on 15 second. There we go. Just liven it up a bit. So I've now got 15 second at the top. I've got the 2 minute here. I've got the 5 minute on the right hand side. Down at the bottom here, I've got 10 minute, 15 minute to the center, and over on the right hand side, I've got the daily chart, which we've already looked at. So that's it building. It's just all red trend monitor throughout the timescales, right up to the 5 minute, across onto the 10 minute now. It's starting to reflect it there, up onto 15. Hasn't quite fully transitioned there. This is the classical shift of colors from bright blue into dark blue, out into dark red, and ultimately through to bright red. And we've got this very bearish situation over on the daily chart here. And it is just a classic example of the movement of or the development rather of a trend, the strength of that trend, and how it's reflected through the prism of the trend monitor with the trend line here. 2 indicators in one, and it's just helping you to stay in. And this is a day you've got to maximize your profits. If this market is going to move quickly, as it indeed it is at the moment, you've got to stay in, take as much money as you can out of the market. It's as simple as that. And that's why the trend monitor was developed in the way it was. We also have the trend dots. I've got that running on the Renko chart. We'll hop over and have a look at that in a moment. But this is just straightforward. Market's falling. So easy. Make money. Now what's happening is quite straightforward. We've got the volatility trigger on 2. We've got a volatility trigger on 5. We've got one on 10. And we've got one on 15. So 2 things are certain. First of all, the market makers are, excuse me, hold on one moment. The market makers are participating. We know that for a fact. Second, we are like to see reversals and trap moves developing thereafter. If I was in this now, if I had a live positions in this market, I'd be closing them out, taking most of the money off the table. If I was scaling out, I'd take a handful of contracts off and leave the rest to run and just see where they go. But I'd take the bulk of the money off, maybe 70, 80%, maybe even 90%, just leave one to run. I can always jump back in again if this market continues lower. But what I'm expecting to happen now, given we've got nice falling market, nice rising volumes, that's all fine. Now what we're seeing, or what we'd like to see, is a reversal inside the spread of these candles. These ones here haven't even closed off yet on the 10 minutes, you can see. And the beauty of the volatility trigger is that it occurs before the candle's closed. So once this is down here, as soon as you get the volatility trigger, then you expect the market to rally. You expect to see this sort of price action. So why not just get out? As soon as the trigger arrives, get out, bank, sit tight, wait to see what happens. If the market congests, fine. If it reverses, even so be it. But if it continues in the same direction, you just jump back in again once it's cleared that volatility trigger. Same on 15. So it's pretty universal across the piece. Obviously, we've moved well on the 15-second chart. That's the one to keep an eye on, because as a scalping trader, you might want to take a long position on this now based on the fact we've got volatility, so a reversal likely in prospect. So you might want to jump in and take a very quick long position. Depends on your taste, on your risk appetite, if you will. But basically what I'd be waiting for now, I'm waiting for this to either clear, congest, or reverse. And if it clears, fine, then you jump back in again and continue in the downwards move. For the time being, the trend monitor is still staying bright red here. You wouldn't expect a flicker of a change yet because we haven't had enough candles formed. Looks like we may be continuing on with this one, staying red. This one's red. This one hasn't transitioned yet, but will ultimately, if we continue on lower. Minor congestion, we're at the VPOC on 15-second. We've now got rising volume and a falling market again, so that's good. Another one popped in there, that's brilliant. Just confirming the strength of the move. Lots of heavy selling going on. It's all down, 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 down. And I can guarantee you one thing. If this is a big money day, which it looks as though it might be shaping up to be, then in a falling market, you are going to make money very quickly. And that's the key to this business. because in the uptrends, it tends to grind. It doesn't often move up rapidly. Occasionally it does if it's sparked on fundamental news, fundamental data, or a Fed release, whatever it may be. It'll move rapidly. But generally speaking, when the markets are falling, those are the days to make big money quickly, because the markets always, or 99% of the time, fall much quicker than they ever rise. So in a falling market, if you have a bias to the short side, which I most definitely do, and that's one of the reasons why, because I make money an awful lot quicker in a falling market than I ever do in a rising market. And it's just the way of the world. It's just a fact of life. And that is because the market makers and the big operators and the insiders are in a hurry when the market's falling, because they want to panic the market, grab as much of it as they can before they start the process of a reversal and upwards trend. It's that simple. They take the time because they've made their money in collecting, in shaking the trees. Everyone throws in the towel, sell, sell, sell. They grab it all. And then on we go up into an uptrend where they take their time making their profits on the way up again. That's generally why the markets move up more slowly than they ever do in the downtrend. Little bit of buying coming in on that candle, as you can see there. It's fairly obvious. Don't need to be a genius to work that one out. So we've got buying coming in here and a little bit of a rally. What have we got? 13 points here might be enough for you on a 15-second time frame. Pretty straightforward. Trading against the dominant trend, which is bearish right now, but that may be your cup of tea. If you want to be in and out all day long, it's perfectly fine. As I said this morning, if it suits your trading characteristic and your personality, fine. But don't force yourself to do things that you find uncomfortable, because you will fail. You've got to enjoy this, and you've got to do what's comfortable, what fits your personality. If you want to trade multiple times a day and you find it comfortable and easy to do, then fine, do it. If you don't find it comfortable, then don't do it. Trading is not about how many times you trade a day. It's about how you make your money in whatever time frames you're trading. And it's a fallacy to believe that it's all wham, bam, thank you, ma'am, and, plenty of adrenaline and lots of noise and shouting, all the rest of it. It isn't like that at all. You can see the rally going on. So, we got out of the bottom here. I've now saved myself 17 points of pain here. So a straightforward decision based on the volatility trigger. A little bit more buying coming in there. Drop down onto the daily, see what that gives us. Well, what it tells us is that we've got some very strong support and resistance. We've got a good platform here below, and we've got a good ceiling above. So we're trading in this corridor at the moment. We've been trading here for around about 3 days or so. So once one of those levels is breached, if it goes to the downside, then we've got another one here, which is pretty strong too. They will get stronger. These have been tested and retested 4 times. This has been retested 3 times. And these little ones here, the thickness of this line just tells us that they've only been tested once, so minor levels. The thicker the line, the stronger the support or resistance region. It's that sophisticated. It does it in real time. It's constantly recalibrating, so every time these levels are tested and held in the various time frames, then it rebuilds them and thickens them accordingly. It's just a visual indicator to give you those price-based support and resistance regions on the various charts on all the time frames. And it's purely price-based, unlike the volume point of control, which is volume-based, as you would expect. But volume is used in exactly the same way. When you come down to these regions, up and down the volume histogram, you've got low volume regions like this. This is relatively lightweight. This is the heaviest area at the moment because we're trading around the volume point of control, this yellow line, which is the fulcrum of the market. These levels here, as I say, they are price-based. They're purely based as normal, as you would expect from a view of price and the number of times that a region has held. Whereas the volume profile up and down the right-hand side is based on volume and is looking at volume, price, and time. This relationship is very linear, the relationship between volume and price. As soon as we swing it up onto the y-axis, we incorporate time, and it gives you all those regions of volume where we've got lightweight volume or heavier volume. And the key to that is that as the market approaches these regions, if it's lightweight in terms of volume, you expect the market to move through pretty rapidly. If it's heavy, then you expect the market to congest. And that is a simple principle, exactly the same as for support and resistance, which is price-based, but we use it in the same way when we're looking at volume. So we're trading around the volume point of control at the moment in congestion on 15-second up onto 2 minute. Looking to try and rally. We're going to trade inside the spread of these candles now because the market closed a third of the way up, so that's an inevitability, but it's what we expect to see. Don't want to trade through that unless it becomes a full-blown reversal. Up onto the 5 minute, see what's going on there. Okay, we've got a decent amount of buying under this candle, nice deep wick to the lower body, so we know there's some buying in there, decent volume below, so we're expecting the market to rally off that and reverse to the upside. How far we will see that will very much depend on a lot of factors, the dollar at least of all being one of them. Let's just head over to the commodities, just see what's going on there. There we go. I've got the currency strength indicator on this one, just pull that out a little bit. The red line is the one to watch, and also this line, which is the magenta line. What we're looking for in terms of further moves to the south for indices, we're looking for more yen buying, which is what we've seen so far. This is on 3 minute, and we'd obviously have this set up across the time horizons. And we've also seen quite a lot of dollar buying in the short term on that. And that's why we're seeing gold. This is gold. I've got the GC contract for the full-size contract here. This is on, again, fast time frames, 15-second, 1 minute, 3 minute, and 5 minute. Works in exactly the same way, precisely the same principles. We've got volume, we've got price, we've got the volume point of control on here, and we've got the trend monitor, of course, as well. And on this was a nice move earlier on, 3 minute. Again, we had this big move higher, volatility came in, ton of volume underneath. This was just before we came on air, and a full-blown reversal in this case. So these guys who were jumping in at the top of this one, thinking that gold was going to rocket and make some quick bucks, and the fear of missing out, FOMO, was triggered, as it always is with a fast-moving market. They are now trapped. Probably most of them have either been taken out of the market or closed their positions at a loss, which is a nice money-making move for the big operators. Very straightforward again. And the reason, obviously, we have the dollar up when we're trading commodities is because all commodities are priced in dollars, and therefore you want to know what the dollar is doing. Is the dollar strengthening or weakening in your particular time frame? And therefore what the commodity is likely to do as a result of that particular relationship. Of course, there are many others, but that's certainly one that you need to have your eye on if you're trading commodities. But it's exactly the same principles other than that. And we have the volatility trigger on 3. We have the volatility trigger on 5 as well. So it really just confirmed it. We've got a little volatility trigger here on the 15-second. And if that's meaningful, then it'll appear over on the faster time frame. Sorry, beg your pardon, the slower time frames of the 1 and the 3 minute. Obviously, as you can see, that price range there is very much wider than what we've seen here, which has all been pretty narrow over the last, where are we, 10, 15 minutes here. So it's not as significant as it would be if it appears on these charts or on this one or this one. And it's a factor always to remember that whatever you're looking at in terms of time horizons, the slower the time frame, then the more significant will be the signal. So if you're seeing support and resistance on a slower time frame, which is significant, then that will have a far greater impact on a faster chart by virtue of the fact that it has a greater proportion of time associated with it. So the greater the time, the more significant, which is why using multiple time frames is so important. Let's just go back to see what the indices are doing. Okay, they're still very weak. This is back to the original workspace. As you can see, this is on the daily, so we've got the Dow here. You can see how much more extended the price action is on the NQ and also on the ES. Let's just go back to our other workspace, then we'll hop onto the tick charts as well, call in there. There we go. This is our multiple time frames. So we're still in a congestion phase for the time being, and that's the reason why, because of the volatility that was triggered. So we've just got to be patient. If we're trading this other than as out and out scalping trader up on the 15-second, then it's a question of waiting, being patient, waiting for this congestion to break, and then jumping into the market once again once it has done. The pivots we use in a perhaps not the way that most traders look at them. This is a nice example up here. Basically what we're looking for in live price action, and we've got it here, what we're looking for is first of all the appearance of the first one, which has come here. So we know we've got a potential congestion building. What we're then looking for thereafter is the next pivot which came in here, and more importantly the third pivot. And what that does is it basically tells us we are in congestion. We've got a pivot low, we've got a pivot high, we've got a pivot low at pretty much the same level. Now what we're looking at is whether we're going to get more pivot highs and pivot lows, and once we break away from that, then we're clean and through that congestion phase. So it's using the pivot as a leading indicator in conjunction obviously with multiple time frames and with volume price analysis. It just helps to define those regions for us, which yes, of course we can eyeball, but it just gives us a heads up. And once we start to get a series of lower highs and lower lows on the pivots, then that tells us that we're either continuing the trend or the trend has come to an end and we're moving into a congestion phase. And what we're waiting for now is a move really to break through, let's say around 76.50. You really want to get away from the low end of this particular candle. So once we've got back down to somewhere in the 76.50, this volatility is then absorbed. It's a little bit like a string that's been plucked, for example. The vibrations are, the oscillations are greatest initially, and then gradually they subside and fade away. And that's a similar principle here. The volatility dissipates. We get back to some normal price action. Albeit in a downtrend, it's going to be pretty fast anyway. But in terms of the trend, normal price action, not volatility-based price action, and we then pick up the trend once more. Excuse me, I'm just going to switch off for a moment. Back again. Sorry about that. Didn't want to hear me coughing. Okay, let's just check in on the Renko. I can't remember what I've got on the Renko. Oh, we're on gold here. Okay, this is the gold on Renko. And this is using the two indicators, the trend dots and the trend monitor together in combination on a Renko chart. A Renko, like the tick chart, we'll drop in on the tick charts in a moment as well, but a Renko chart is exactly what it sounds. It's a non-time based chart. There's no time element to this. There's no time aspect to it. The chart, the bricks will build according to the setting that you either prescribe or the one that's automated for you. With this, the Renko optimizer, what it does has two functions. First of all, as I say, you can select your own brick size if you wish to. You can have so many dollars per ounce, or so many index points, or so many pips, whatever it may be. Or alternatively, you set it to automate, and you do that through the user inputs, and then it will automatically tell you what, or deliver for you the correct setting for this particular market at this particular time in the trading session. And we can apply any indicators to it. So we've got the trend monitor here, we've got the trend dots, and we've also got the support, the accumulation distribution indicator here as well, all working together. The trend dots are very close to the price action. You can see here, supporting, supporting, supporting. Then they roll through. They start to change color. We've got a gray one here. Then we're into the downtrend in red, and they move to the top of the candle, the top of the price bar. So in other words, they're adding downwards pressure. And once the trend dots move through the body of the candle, they then become the underside of the candle. In other words, they're providing pressure to the upside. But the trend monitor is more considered in its view, so you have to use them in combination. As you can see here, we don't get the transition here until this has been developed into a trend. So you've got to use the two together. The trend dots will transition first. The trend monitor will always come afterwards. So it's a question of how early you want to get in. You can also adjust these sensitivity-wise to suit your own attitude to risk, if you will. You can smooth out these regions. You can increase sensitivity or decrease sensitivity according to your preference. So we've built that control into the indicator as well. And of course, on the accumulation distribution works in exactly the same way, where you've got thicker areas of support and resistance and less thick areas. You've got quite a few on here. And you can also reduce these numbers if you want to take off and just show the more dense areas. Let's just go back on the indices, see what's going on. I'll go back onto gold in a moment. Okay, we've got a little bit of a rally here, but it's all looking a little bit weak right now. Some buying under here, as you can see. Selling pressure, interestingly, is falling away on that sequence of candles, but it's still pretty high, so it's a question of whether there is enough buying to actually drive this market higher. This looks a little bit weak for the time being, but there is buying in here, so there's certainly been an effort to rally, but it's all looking rather weak. And where are we heading in terms of where are we likely to find? Let me just move the chat box out of the way. Where are we likely to find some difficulty? In other words, a barrier to an advancement of price. Well, there's several on the daily chart. This is the ES. We're trading at 29.08 at the moment. If we get down to 2900, in other words, another 8 points, which is 32 ticks, we've got several which will bring this market to a halt. The first is this very well-defined platform of support here, very thick line, so it's a deep area that is likely to hold the market, or hold it up at any rate. You've got another layer immediately above it, so you've got two areas here acting as a cluster, so it's doubly strong, if you will. Below that, we've also got the point of control, which will then come into play, and whenever the market gets to or reaches the point of control, then you can almost certainly conclude that the market is going to congest at that point. If for no other reason that we have a ton of volume here, we're also trading in a very, very thickly congested area of volume here in terms of this daily chart. And for this market to rally, it's been capping off at this region for a long time now. This is why this level is absolutely key. It's one of the areas we identified on one of the posts we've done fairly recently. It's absolutely critical. If this market is going to rally, two things are going to occur. First of all, we're going to see it rising with rising volume. And secondly, it's got to break through this area and get up to this next level, which is relatively lightweight in terms of volume. And until that happens, this market is going to trade in this region and probably break down in due course, because if it cannot rally through there, then there is nowhere else for it to go other than down. The issue, of course, at the moment is we are in the summer, the depths of summer, the dog-end days of summer. And until we get through early September and we get full market participation again with volumes increasing once more, then that is the point at which this will dictate really, truly where this market is going to head as we come towards the end of the year. And as Anna said alongside me, that is down to Mr. Trump. And he's trying to scare the Fed at the moment, but he's not succeeding for the time being. But there we go. Let's just go back onto the multiple time frame for the NQ. There we go. We're going to get another breakdown. This is the level I mentioned here. Once we get down to this sort of region, we'd be jumping back in again as soon as we've cleared this volatility. Let's have a look at the NQ chart. I haven't got the volume point of control on here at the moment, forgive me. But a similar sort of picture, we're capping off at this level, very heavy, and exactly the same. We'd have the same sort of volume histogram on there. Volume point of control will be around here somewhere, and a ton of volume and lighter weight volume down here, and certainly up here. And a lot of signals of weakness in here. I mean, you only have to look at candles like this. You've got the rollover here, the market flattening. This is always classic when you see price action here, like flattening, it then starts to roll. This one rolls, then you get a day like this, big rally, ton and a half of volume under it. I mean, there's no way on the planet that isn't weakness. And down we go for 2 days, which was fantastic. This was a fantastic trading day, a massive money day, as was this one. This was pretty good too. This was an up day, reverse obviously. But as I say, these guys here, these are the days when it's just a question of making money fast. You've got to remember also that most of this price action will have happened in a relatively short space of time. It probably won't have happened in the morning, but it will certainly happen once the cash markets open alongside Globex. So you're talking about a 5-6 hour window when you're making money very quickly indeed. Okay, flip-flopping around the trend monitor here, as you would expect. Now we're in congestion, works exactly the same way. It's still bearish. It hasn't transitioned through to blue or dark blue. Not a flicker on here, still bright red over here, still bright red over here, and still bright red down here on 15 now. So we've now transitioned out the other side on 15, and that has joined the other 3 or 4 time frames as well. Really painting a pretty gloomy picture. Just go back onto the commodities trading page. There we go. Just on gold. Dollar's come off a bit. You can see there, this is on, there we are, this is on the 3 minute. This is gold, the red line. So we've had a decent amount of buying over the last hour or so. Now it's starting to sell off a little bit. We're also starting to see in terms of indices, you're starting to see this blue line. This is the Ollie, this is Aussie dollar, this is a risk currency. And equally, you've got some selling of the yen coming in, certainly on this faster time frame at any rate. So from a risk perspective, we're starting to see some risk on appetite come into the market. We've got a cross on the Aussie yen, so the Aussie yen will be rising at this point. Certainly from here on anyway, purely because it was oversold and is now rising strongly. The yen was overbought and that is now starting to fall. And that's part of the reason that you're seeing a pickup in indices and a minor reversal in sentiment on those charts, certainly on the faster charts at any rate, because the risk sentiment has shifted from risk off to risk on for a short period of time. That may well develop. And again, using the CSI multiple time frames, you'll be using it across whatever your time window is to get a perspective on what is going on. You can see here the dollar is falling, so what we'd be looking for now is a gold trader, maybe a nip in to take some money on the long side. Might not be staying in this for very long, but we're trading around the volume point of control, up on 15 second. We're rising nicely. Trend monitor's come out of its transitional phase here. We've got a very nice platform of support in below us now, very strong at 15, just above 1509. $1,509 spot 60 per ounce. Now we're moving up to 1510. Trend line's rising nicely. Volume's a bit lightweight under that one. We've got 2 candles there side by side. This one should be taller than that one. It isn't. So, a little bit of a cause for concern, but not majorly. What are we doing on 1? Okay, trend monitor's transition to 1. Trend line's rising. That's all nice and hunky. We've got a little bit of minor resistance ahead. We want to go through that at 10.4. If we get through that, we'll be going on up again. There we go. Lots of volume coming in here. A little bit of weakness on that one because we've got a wick to the upper body. Just keep an eye on what's going on in terms of the dollar. Still falling at the moment, certainly on 3. Aussie's rising. Yen's flattened off, as you can see there. Okay, carrying on up. This is nice. So we've now got almost a dollar per ounce in the bag. We got in at this point. Very handy. Bear in mind, we're still down at the VPOC on 3 and also on 5 as well. We're still trying to come out of transition here into bullish on 3 rather, on the trend monitor, which we haven't yet done. A little bit of selling coming in. We've got a 2-bar reversal here. We've also got bearish engulfing on the 15 seconds, so we're expecting a move to the downside, which is what we've got. Now we've got volatility, big volatility trigger on 15 second. See if that transitions on 1 minute. See if we get it there as well. Certainly got it here. Ton of volume coming in. The big operators are playing. We've got a strong platform of support in underneath. This market's going to reverse into that. Expecting to see the market rally off that. Dollar's still falling. No volatility triggers on the other candles though, so this is just a 15-second one. Nevertheless, it can be read in the same way depending on what you're doing. Weak reaction in terms of up moves, but the support platform is still holding. It's just keeping the market up there for the time being.
Okay. Sorry, Darren, I'm ready.
Just going to switch off for a moment. Big move on pound Aussie apparently from this morning. You can see the strength. I'm on gold at the moment. Aussie rising very strongly. You can see it here. It's really climbing quickly. The dollar's falling, but it's not falling as rapidly as Aussie is rising. But certainly, if you were looking at Aussie dollar, be a nice move on there right now. Aussie Swiss even more so. Look at this fall in the Swiss. That's selling of risk, selling a currency that's a risk currency. So there's a shift back to risk on. And that's what I mentioned earlier on. The yen here is flattening off. We were seeing the selling of the yen also. So when you've got selling of the yen, the Swiss franc, then you've got doubly risk on, if you will. But it's also combined with the fact that we've got buying of the Aussie, we've got buying of the New Zealand here. So both of those could be considered risk currencies, but certainly the Aussie, the greater of the two. We've got commodity currencies climbing basically, other than the Canadian dollar here is not flatlining at the moment, so it's wallowing about at the bottom. Where are we going with gold? We've reversed into that candle, which is what we expect to see. Touch the volume point of control. This level acted as support, which is what we expected as well. So it's all given comfort. We're back on the way up again. Dollar's still falling over here, which is very nice. Volumes here are a little bit lightweight. You want to see a little bit more than that. Want to see it rising as well. Let's go down onto 3 minute. There we go. And for further advance of the price, we want to get up through into this region, up into 15.11 per ounce, this sort of area, because at that point we're through into lighter volume on the volume point of control. So it will take less effort to breach that region for a more sustained move, and very light in terms of any price-based resistance as well. So doubly positive, if you will, if you're trading that to the long side. The trend monitor, as you can see, has not yet transitioned through to fully blue, but it's certainly on the way. It's gone dark blue. And the next phase out of that will be the trend line will adjust and move, crawl away from the midpoint here, this black line, which is the center line, if you will, and it will start to climb. And at the same time, simultaneously, the trend monitor will transition through to a brighter blue as well. Through into lightweight volume here, a little bit of weakness coming in there. We've got a wick to the upper body, good volume under that last candle, so probably a little bit of a pullback maybe. Let's see what happens. Similar sort of thing going on over here. Let's have a look at the, this is on the 1 minute. Volume's okay. Okay, we've got a little bit of wick top and bottom, but we've got a nice relatively low area of volume here. Not as low as down here, obviously, but this is certainly lighter than that. The volume point of control is right up here as well, so maybe that's where we're heading to. Trend monitor is nice and brightly blue. Trend line's not terribly aggressive, but it's nevertheless the right side of the line for us. We want to see it kick up a little bit and move more strongly to the upside. The trend monitor is 2 indicators in one. You get both these indicators, the trend line and the trend monitor, come as a pair, if you will, 2 indicators in one. On up we go through 15.11 now, up to up to the half. See if we can get another dollar out of this. Nice volume under that one, big surge in volume. No volatility, which is very nice, so we're expecting a further move higher, which is lovely to see. And bear in mind, this is a big contract. You're making money quickly now if you've got one of these futures contracts in place. Very nice, very healthy. On we go. Lovely jubbly, happy days. Dollar is still falling neatly, that's nice. Risk on appetite's rising. Aussie is still rising strongly, as is the New Zealand dollar. Swiss franc's falling like a stone, that's very nice too. Okay, a bit of weakness coming in on 15-second, wick to the upper body. People taking profits, markets move rapidly. Plenty of people in here making a ton of money. So, take some profit off the table. 2-bar reversal now, expect to pull back from that. Trend monitor is still blue though, hasn't transitioned on 15 seconds, certainly won't on 1 minute yet. And we're still waiting for full transition on 3 minute to follow through. And of course, ultimately down onto the 5 minute if this develops into a longer term bullish trend. And the dollar falling all the time is always going to help as well. You do get gold and dollar rising simultaneously. It happens, as indeed they fall simultaneously. When they're rising simultaneously, it's not good news at all. But it happens from time to time. It certainly happens intraday as markets sort of flop around. Weakness coming in, you can see it here on 1 minute. Don't have to be Brain of Britain to work that one out. Ton of volume, nice big wick to the upper body, and we've got a nice a hammer candle there that's going to sit at the top of the hill probably, and we'll see a pullback off that. So if you're in that one, might be time to close out. You can see it here on 15 second as well. There we go. Ton of volume. Market didn't go anywhere. Well, it did, but it closed out halfway down the body of the candle. So lots of selling in there. The volume tells you that. The price candle reinforces it. Where's the market going to go off that? Only one way, down. Through the volume point of control. Now we've got lightweight volume. If that's going to continue low, it's going to move through there very quickly. Volume's fallen away. Look at the up volume now, very weak and weedy. This stands out like a telegraph pole. Excuse the analogy, but it does. You can't miss it. Such a straightforward signal, and all confirmed with the indicators as well. You can start to see the transition now. We're seeing the trend line that's dived right off the highs. We're coming back to the median point. Trend monitor through the dark blue. Hasn't changed here, but you wouldn't expect it to, not yet. This is a 1 minute, so it's 4 time frames upstream. Not a flicker on 3, but you see the weakness on 3 as well. There we go, the wick to the upper body. High volume under that one. Let's pull that up a bit. The reason that's distorted so much is by this fella over here, which is an absolute 1.5 tons of volume. I mean, you just couldn't miss that particular signal. Just very straightforward. Let's go back to the indices, see what's developing over there. Have we broken out yet? Where are we? Where are we? There we go. There we go. Nope. That's what we're seeing. That's what we expect to see. Why? Because the Aussie yen is rising, risk on appetite has returned. You've seen it in the forex market. It's developing in the indices. The two go hand in hand, and it's one of the things we teach in detail in the forex trading program. If you understand the relationships in the markets, you will have a 99% better chance of winning in this business, because you understand the linkages, why they occur, what they tell you, and which markets to consider when you're trading particular currency pairs or particular markets. Bonds, commodities, indices, stocks, it does not matter. And this is now turning into a full-blown reversal. And how do you think these guys feel who've jumped in here? The Johnny-come-latelys, they've jumped in on that move, and they are now being squeezed until the pips squeak hard. If they're still in there. Probably not. Okay, these are the pivots I mentioned. We have pivot low, pivot high, pivot low, pivot high. We're into congestion. Got the volume point of control. Excuse me a moment. Now coming out the other side. Very straightforward. Great day. Nice day for trading. Lots of price action, all going on. I'm going to pass back to Anna. Oh, we didn't go to the tick charts. Have a quick call on the tick charts. Okay. All right, just going to pass back to Anna for a change of voice. Don't think there are any questions. Sorry, I have my chat box closed. No, we're okay.
Everyone, okay, right, just a couple of interesting bits of news. The first is I don't think it's literally, I just picked it up a minute ago on my Twitter feed, which is quite very significant. It appears Jay Powell has ordered a media blackout for Fed staff, in particular the members of the Fed that are voting members, and this is something that you know is quite significant, because tomorrow he is at Jackson Hole. Jackson Hole is a yearly, they call it a symposium, where basically all the central bankers get together. Where is Jackson Hole? Is it in Wyoming? It's in Lovin. Is it in Wyoming? For those of you who, I'm afraid my geography is a bit hazy where Jackson Hole is. Is it somewhere in the Rockies? Anyway, I'm sure it's a lovely, the most wonderful part of the world. Anyway, it's tomorrow. But Powell is, as you know, is at really daggers drawn with Trump, or rather Trump is not happy with the Fed. But just to say about the Fed, as far as the Fed's concerned, they have actually fulfilled their remit, or rather the two parts of the remit, which deals with employment and with inflation. Basically, there isn't any, but obviously, the global economy, and especially the issues with the tariff. Let's call it a tariff war between the US and China. How much influence they have over that, I don't know. That's down to the US administration. Anyway, expect lots more fractious language from Donald Trump. Every time he makes a comment about was it a comment about the Fed, David, and what they should and shouldn't be doing. Invariably, yes, it seems to affect the market. I suppose, David and I take the view that, whatever you trade, you look at the technical picture, you look at what the fundamentals are saying, and you look at related markets. We've seen what David was doing with the gold chart. You look at the dollar. So you trade a commodity, and you have to be acutely aware of what is going on in the forex market, and especially the US dollar. But I think there's a fourth dimension now, and that is politics. It's almost as if politics, well, they're kind of driving the markets, as it were. So it's a very, very different landscape that we are in when we were started 20 years ago. Now, the reason I came over to NT5 is you can trade you can trade almost any market these days on the MetaQuotes platform. I think with TradingView as well. And if you don't want a futures account, because obviously with the futures, even mini futures, you still have to have a reasonable amount of margin, don't you, David? You have to have a deposit in your account. So the option you might want to consider is trading it as on one of the brokers that offers it, as you see here, they call it the US 30. Which is the derivative, which is a version, not a version, it reflects what is happening in the Dow. Now, what I've done here, I've actually got the 3 time frames that I've been using for Forex, which is the hour, the hourly chart. Where am I? This should be the daily chart. I do beg your pardon. Hold on a second. There we are. I've got my daily chart here. Let's look at these 3. I've got the hour, I've got the 12-minute, and I've got the 3-minute. If we start with the hourly chart, actually, we won't start with the hourly chart. No, we're starting with, let's start with the 3-minute chart. This is the fastest chart. And if we look over here to the left of the chart, you can see here, this is just before the US Open. Now it says here 16:30 because the time stamp on this particular MetaQuotes platform is actually 2 hours ahead. So when it says 16:30, it's actually 14:30, which is the start of the US session that we have here in the UK. So I know this is the start of the US session, but look beforehand and you can see the volume here that you can see that accompanies these candles here. In fact, the YM was actually in sideways and not really going anywhere. There's a volume point of control here. As I said, this is volume, price and time. This is support and resistance based with the volume element added to it, which is this yellow line here. It was in sideways, moving sideways. Really, market couldn't decide whether it was going to go up or down, and that's very typical because, as I said earlier, we're waiting for the physical market to open. Then we had the usual reaction. We had a ton of volume going in. We had volatility candle, as you see on those two, pushing the price up. And eventually then we have this little candle here with a reasonable amount of volume underneath it with a wick to the top of the candle. Resistance at, I've got here 26,371. These values may not correspond directly precisely with what's happening in the futures market. This is like a synthetic contract, as it were. It just allows you to participate, to take a trading position in an instrument that, if perhaps you don't have a futures account, but you still want to trade what you think is happening on this particular chart. Then we had the usual, we had the reversal, we had a volatility candle on this down bar, with a lot of volume underneath it. So what happens with when we see that, we saw it here as well, is you expect the price action to retrace to within the spread of the volatility candle, which it did, but then because it's the open, it did actually carry on higher. But on the way down, we have the down candle, the volatility, a lot of volume. Then we have these two little pullback candles, corrections. But look at the volume. You have that volume under this one. This one is narrower, and the volume is also falling. So telling us that possibly, you know, this retrace to within the spread of the candle is not going very far. Now, when you have a volatility candle, the way you have to see a volatility candle is it gives you another support and resistance level, as it were, levels from a support and resistance perspective. So we know if the price is going to carry on higher, it has to take the high of that candle out. If it's going to go lower, it has to take the low of the candle. Now what happens is we know that's not going to go very far based on volume. Then you have these three little candles here in sideways congestion with a lot of volume underneath it, but it isn't going anywhere. There's an awful lot of effort going in, but the price isn't going anywhere. If that was going to, if this amount of volume going in should have moved that candle lower, but it hasn't. It's the price, and also it's still within the volatility candle. When does it actually start to move? Once it clears the bottom of the volatility candle, and there we know it is going to go a little bit lower. It does the same thing again. We have a little pullback again. The volume slightly, you have a very squished candle. You have these this is what we're looking for in volume price analysis. We're looking for anomalies. We're looking at price and volume that doesn't look right, and it doesn't look right for a particular reason, and the reason is it's not authentic. Then you have this up candle, the volume is slightly lower. Then we come back to the volume point of control, which is where the move originated from at the open. And this is where it gets really interesting, because if you've missed all this, once price gets to an area, in market profile terms, it's a sort of a value area. It's an area where the market has been imbalanced at some time. Then you're potentially looking for a breakaway, and that is what we have. We have this. Probably wait until the VPOC has been breached with volume. So we have, you know, that volume with that candle looks okay because it's in agreement. It's not a huge candle, it's not a huge amount of volume. Then the next one slightly higher than the previous one on the down candle. Then we get another anomaly, so with the breakaway is underway. Then we get this anomalous candle here, a ton of volume underneath it. What's happening? Nothing. So what does that tell you? The chances are it's going to go lower. Then the next two candles are absolutely beautiful, because you have falling price on this one, falling price, and you have rising volume, and that's what we want to see. Now, it's in this kind of waterfall that we're seeing, the beginning of the waterfall, you will always get pullbacks and corrections, and this is where you have to look at what are the candles and what is the volume telling you. If they're not in agreement, the chances are it is going to carry on lower, and indeed it does. This carries on lower, this carries on lower. Now at this point here, it hits some support at 26,102. Then you have this candle. Now this looks much more as it should be, and in fact it's a sort of is a bullish engulfing. It doesn't carry it very far, because the next candle actually comes back and tests the support region, and we move a little bit sideways before we start with the move higher. Now the problem with this move higher at the moment is you have a lot of volume under that candle. There is a wick to the top of the candle, but there's really an awful lot of effort going in. But the problem is with these three candles, you've got rising prices and you've got falling volume once again. So is this likely to be going higher? Probably not. Now, how you put that analysis in the context of another time frame. So let's look at the 12-minute chart, and here we have this is the open again. Where are we? 1612, just before the open. We have this huge rush higher, which was the candles going up on the 3-minute chart. This candle here is these 4 candles here. 1, 2, 3, 4. There we are. If you put them, overlay them all on top of one another, you end up with a shooting star candle, which is why you have to use multiple time frames. You have a big shooting star candle, a ton of volume underneath it. What is that telling you? This is not going to go very far. You have an up candle with a lot of volume, but look at the spread of this candle. Look at this one. This was the range. Look at that volume. Didn't go far. This is narrower, had a little bit more volume, still not enough to push this higher. And then this is the waterfall that we've seen on the 3-minute chart. It's gone below the volume point of control, and it looks like it is now coming back up to test it. And if we go up to the hourly chart here, what do we see here? This is the open. This is this big fall that we see. This is all the price action contained in one candle that we have seen both on the 3-minute chart and the 12-minute chart. So this is, if you don't have, I have a Renko on here as well, which I haven't loaded for this particular index. I can do so next time. Having a Renko chart helps to smooth out the price action and helps you not only with your entries, but also keeping you in and then eventually taking you out. But the point is here, these are 24-hour markets, but actually you're trading 3 separate and independent markets. You're trading the Asia session, you've got Europe and London, and then obviously you've got what happens in New York. And then the cycle repeats itself on the next 24-hour cycle. But you really have to see them on an individual basis. So we'll see what's happening with the YM. Is there anything you want to add to that, David? No, you are? Oh dear, fine, okay. Lovely. That's what I've got to say on that. Can I just come back to you, because you said you had something you wanted to say? Yeah, you got something to...
Thanks, darling. And hopefully you can see my screen again. Yep, there we go. And as you can see, the rally on the indices, this is on the NQ, is now taking shape nicely. And you'd be making money to the long side. And if you were short and you got out here, you'd be quite happy and looking to get back into this market that's now developing to the upside with a full-blown reversal. All come off the volatility trigger and all being confirmed now with the trend monitor. You can see a stunning transition. We've transitioned on 2, not yet to change on 5 or indeed 10 at the moment. But if this continues, then ultimately that will. We've run way over time. Sorry about that. Really appreciate you coming along today. Hope you've enjoyed it. Enjoy the rest of the trading session, the rest of the trading day, and have a great day tomorrow and a great weekend ahead. And we will see you back here same time, same place next week. So thanks a lot for coming along to us. We do appreciate you spending time with us and hope you've enjoyed it and found it useful. See you soon, and bye for now.